As of the market close on Friday, January 23, 2026 at 4 p.m. EST, NVIDIA stock finished the session at a price of $187.67, representing a solid intraday gain of 1.53%. Throughout the final trading hours of the week, the equity showed significant resilience, oscillating between a daily low of $186.82 and a high of $189.60. This upward momentum stands in direct opposition to the cooling sentiment seen in broader tech indices earlier in the month, signaling that the institutional appetite for the semiconductor giant remains insatiable even at these elevated valuation levels. While the retail crowd often focuses on the flashy headlines of new chip releases, the real story moving the needle right now is the massive, quiet shift in institutional positioning. The expectation held by many casual observers is that NVIDIA has reached a temporary ceiling, especially given the sheer magnitude of its multi-trillion-dollar market cap. The common narrative suggests that the easy gains are over and that the stock is merely a passenger to the overall market's volatility. However, the reality on the ground is far more aggressive. We are seeing a fundamental decoupling where NVIDIA is no longer just a chip maker, it has effectively become the primary infrastructure layer for the global economy. This week's price action was heavily influenced by reports that major Chinese tech firms have been cleared to resume orders for high-end silicon, specifically the H200 variants, which immediately injected a fresh wave of optimism into the trading volume. This creates a curiosity loop for any serious investor. If the most restricted markets are finding ways back into the ecosystem, the projected revenue floors we once relied on are likely far too low. When you look at current NVIDIA stock performance, it's easy to get lost in the green candles, but the underlying mechanics tell a deeper tale of supply chain dominance. We often hear that competition from the likes of AMD or Intel will eventually erode these margins, but the data suggests otherwise. Institutional activity in the last 48 hours shows that large-scale funds are not just holding, they are actively rebalancing their portfolios to increase exposure ahead of the next fiscal report. The tension here is in the valuation trap that bears have been shouting about for months. They point to a price-to-earnings ratio that looks stretched compared to the legacy industrial sector, yet they ignore the fact that the forward earnings growth is accelerating at a rate that traditional models simply aren't built to handle. If you are using a standard individual brokerage or a modern platform like the Robinhood app, you've likely seen the volatility, but the long-term trend line remains remarkably steep. NVIDIA stock is currently navigating a landscape where macroeconomic pressures like interest rate uncertainty and trade tariffs are being overshadowed by the sheer utility of its hardware. While other tech giants are struggling to justify their AI spending to shareholders, NVIDIA is the one collecting the checks. This is the ultimate pick-and-axe play of the current decade. Recently, the trading volume exceeded 142 million shares in a single session, a figure that highlights the liquidity and the massive hands-on involvement of hedge funds and pension funds alike. This isn't just retail speculation on a Robinhood trading interface. This is the backbone of modern wealth management. Even conservative outlets like Fidelity or Schwab Intelligent Portfolios are seeing their tech-weighted baskets being carried by this single ticker. It's a reality that forces a rethink of what diversification even means in 2026. To understand the business model that supports this $187.67 price point, we have to look at the transition from Blackwell to the upcoming Rubin platform. This isn't just a hardware upgrade, it's a total reimagining of how data is processed. Most people think NVIDIA just sells parts, but they actually sell an entire ecosystem. CUDA. This software moat is why developers find it nearly impossible to switch to competitors, no matter how much cheaper the hardware might be. This is the common ground where reality clashes with expectation. Investors expect a hardware cycle, but they are getting a software lock-in. This is why when you check your SoFi Invest account or browse through your Interactive Brokers platform, the buy ratings for NVIDIA remain so lopsidedly high. Out of over 60 analysts currently currently covering the stock, more than 90% maintain a bullish stance, with price targets stretching towards the $250 to $275 range. Looking at recent earnings, the company reported a staggering $57 billion in revenue for the third quarter of fiscal 2026, which was a 62% jump from the previous year. Data center revenue alone accounted for over $51 billion of that total. This is a business that is essentially printing its own currency. For those of you watching this, I want to hear your take. Comment below how many shares of NVIDIA stock you currently hold and whether the $200 mark is a foregone conclusion for next month. The engagement in the community surrounding this stock is a metric in itself, as it reflects the sentiment of this self-investing crowd that has become a formidable force in price discovery. Whether you are using the Fidelity mobile app for its research tools or the Robinhood Investments tab for its simplicity, the conversation is the same. Is there any force that can actually slow this down? The older reports from 2024 and 2025 often talked about AI fatigue, the idea that companies would stop buying chips because they weren't seeing an immediate return on investment. The reality of 2026 has proven that theory dead. We are now seeing AI necessity. Companies aren't buying these chips to experiment, they are buying them to survive. This shift from discretionary spending to mandatory infrastructure is the primary catalyst behind the recent 1.53% bump. When the market sees that tech giants like Microsoft and Alphabet are still increasing their capital expenditure, it validates NVIDIA's entire existence. Even in the realm of online investing, where trends move at the speed of light, the stability of NVIDIA's growth is becoming an anomaly. It has effectively replaced the older industrial stalwarts as the safe bet for growth, a concept that would have seemed insane just 5 years ago. If we look at the competition, AMD and Intel are certainly making strides, particularly with the Ryzen AI series and the Panther Lake chips. However, NVIDIA has successfully moved the goalposts. While competitors are focused on matching the specs of last year's NVIDIA chips, CEO Jensen Huang is already talking about the AI factory concept, massive physical construction projects that turn electricity into intelligence. This is a point of tension for investors. Do you bet on the company currently leading or the ones trying to catch up at a lower price point? On platforms like Interactive Brokers or Fidelity Brokerage, the smart money seems to stay with the leader. The technical analysis supports this, with the stock recently clearing key resistance levels and finding strong support near the $178 mark. The volume profile suggests that every minor dip is being aggressively bought by institutional algorithms, leaving very little room for a deep correction. The risk factors are still present, of course. Geopolitical tensions regarding manufacturing hubs and potential regulatory hurdles in Europe or the US are always looming. But the reality is that the world's reliance on this specific silicon is so high that any major disruption would likely crash the entire global market, not just NVIDIA stock. This too big to fail status is another reason why it dominates Fidelity ETFs and various intelligent portfolio products. It's no longer just a growth stock, it's a systemic component of the financial system. For the individual investor using investing help or searching through investing sites, the message is clear. The narrative of a bubble is being challenged by the reality of record-breaking profits and tangible massive-scale utility. What does the future hold as we move deeper into 2026? We are likely to see a continued expansion into the automotive and robotics sectors. While data centers are the current profit engine, the long-term reality is that every moving machine will eventually require an onboard AI brain. This is where the expectation of a peak once again falls short of the potential reality. If NVIDIA can capture even 20% of the future autonomous vehicle market, their revenue from gaming and professional visualization will look like a rounding error. When you use tools like the Robinhood Cash Management feature or look into Fidelity Wealth Management, you are seeing the results of a world that is becoming increasingly automated, and all of that automation runs on NVIDIA hardware. In summary, the journey of NVIDIA stock from a niche gaming company to the most valuable entity on the planet is a masterclass in market psychology versus economic reality. The live price of $187.67 is a reflection of a market that is finally beginning to price in the permanence of the AI transition. We started the day with expectations of a flat finish, but the reality of institutional buying and positive regulatory news from overseas pushed us into a 1.53% gain. The curiosity loop remains open. How much higher can a company go when it literally owns the future's infrastructure? We have seen a massive disconnect between the bubble fears and the profit facts. As long as the earnings growth continues to outpace the valuation expansion, the ceiling remains a moving target. Whether you are managing your own Fidelity IRAs or just started your first online investment on a mobile app, the core insight is the same. Don't mistake a high price for a peak when the underlying fundamentals are still in the early stages of a decade-long expansion. The reality of